G'day and welcome to another episode of Perth Property Insider. I'm your host, Jared Mann, and today I'm going through the age-old question, should you buy shares or property? Now, investors can get very solid and passionate about both these camps. You only need to see some of the forums and groups online to see just how much people believe in one or the other. But what's right for you and your stage of investing? Today, I'm really excited to have Stuart Wemyss of ProSolution Private Clients come along and give us some of the pros and cons, benefits and negatives of each of these asset classes and how you can think about sequencing and timing them as you grow your wealth. So let's go inside.
Welcome to Perth Property Insider, where you will learn how to grow your wealth and improve your life using Perth property. Our show is brought to you by Investors Edge Real Estate, the highly rated and award-winning property management specialists servicing the whole of Perth. Now, here is your host, Jared Mann.
I've been getting asked a lot in our Perth Property Investment Facebook group, should I invest in shares or should I invest in property? And which one's better? And how do you decide? So I wanted to get someone along that is actually an independent financial advisor, because of course, if you go to the local real estate agent or your property manager and ask them, like I am, I'm going to be heavily biased towards property. And if you go to most financial planners, they're not going to know much about property and going to be so into shares that you'd be lucky to even get to own your own family home with their advice that they give you. So today we've got Stuart Wemyss from ProSolutions along, and I'm very excited to be chatting about the pros and cons of each. Thanks for joining us, Stuart.
Hey, Jared. Good to be back with you.
So take us through some of this historical performance of each asset type, because it's good to look backwards. And I know you're very evidence-based with your advice, which is why I align with it so much.
Yeah, and look, I try not flog a dead horse, but even before we get into returns, I mean, in your introduction, you make a really good point. If I'm going to go off and get advice from a financial advisor, of course, I want that advice to be in my best interest. But it's really important then to consider the advisor's experience and scope of knowledge. Because really, if they feel very comfortable with shares and that's kind of in their wheelhouse and they've got some sort of ancillary sort of knowledge of property, then as a general tendency, they're going to go with something they're more comfortable with. And so I don't believe everyone should invest in property. And I don't believe everyone should invest in shares. In fact, I believe that a combination probably suits most people. But also, if I meet a client and they say to me, Stuart, I hate property or I hate shares, either or is fine with me. Both asset classes have their merits, which we'll talk about. And you can typically build assets with both classes, we'll build wealth with both classes as well. But it's really important if you do go out and get advice, how much experience do they have in those two main growth asset classes, property and shares? And I find, and I think this is the biggest indictment, the financial planning industry's cleaned itself up a lot. No more commissions. There's fewer conflicts now, not none, but fewer. But the remaining big problem is making sure that advisors have just as deep knowledge and experience in property as they do shares. And unfortunately, that's not the case today. But I imagine, I hope that the industry sort of evolves and upskills in that area. Anyway, putting that aside, the answer is, when you look at sort of long-term returns, the answer is they're both great. And they've both got a strong history over long periods of time of generating relatively similar returns. So you look at the Australian share market, since the ASX 200 index began in 92, has returned 9.1% per annum. The US market, since 88, that's when the S&P 500 began, at 10.6. So, there's not too much difference between that. If you look at the average capital growth rate, Melbourne, Sydney, you could even throw Perth, really any of the capital cities, it's circa 7.5%. And then if you add, rental yield on top of that, it's depend on the asset that you have, but even net of expenses for most properties, it's going to be 2.5-ish%. So it's really 7.5 growth plus 2.5 income gets us to about 10%. So when you look at, whether it's the international share market, the Australian share market, the US or Australian property, we can pretty much confidently say over, a 4-decade period, the returns have been broadly similar, around about 10%. And so the answer is, or what I would say to people is, well, if you can earn 10% per annum over a long period of time, you don't actually need to do much more than that for most people, in order to build substantial wealth. If you can, most investors would be very happy with that. 10% return means your asset base is more than doubling every 10 years. I mean, that's an excellent outcome. Now, of course, these are longer term returns. And so over very long periods of time, when we compare asset classes, they look very similar. But what's hidden in those returns is volatility. And of course, that's one of the main, I guess, observations that people have, or concerns, if you like, about investing in shares, is the volatility rate is around about 20-ish%, whereas the volatility rate of Australian property is about 10%. So it's half as volatile as shares. And that kind of makes sense to everyone. Property feels a bit safer because the value doesn't change very much. Shares feel risky because, it's up 3% one day and down 2% the next. But I would say to people, when making investment decisions, volatility really doesn't matter. Like, it's end to end. If I invest in an asset and I'm going to hold that asset for 20 or 30 years, do I really care how often the price changes? I only really care, what is that asset going to be worth in 20 to 30 years from now? So look, I acknowledge the volatility argument around the two asset classes. And certainly if you're really petrified of volatility, then maybe steer away from higher volatile asset classes. But I think that's more of an education piece for people and investment decision making, rather than something fundamental that should impact their investment decisions.
And I guess it comes back to people's timeframes. And I'd argue that if you're not looking long term, you probably shouldn't be getting into any asset class. And so it takes it more from the investing space into the, trying to produce an income, or having a job, or potentially even gambling at the far end of that spectrum, wouldn't you say?
Yeah, I think short-termism encourages us to be speculators rather than investors. And also having too shorter-term focus really invites you to make mistakes. Because what it does do is it really encourages you to listen to the noise that's going on in markets at the moment. So if we think about the noise at the moment, it's all about interest rates and property prices potentially falling 15, 25%.
Well,
it's
on your side of the country, Stuart.
Yeah, that's right.
A little better over here in Perth. But,
yeah, that's right. That's right. So, US recession, there's lots of noise, right? But none of those things, if we ask ourselves, will any of these things matter in 20 years' time? Will they really matter to us or to really markets and returns? The answer is no, of course. So by focusing too shorter term, it does invite us to get influenced by those things. And as a result, we'll end up making probably not a sound fundamental decision.
And the other thing I found really interesting is when you're looking at that around about 10% return from each asset class, it's interesting here when I look within the property asset class too, because you mentioned some of the typical growth rates at 7.5% and yields at 2.5%. And what I find as well is that if you go towards the other end of the spectrum and you're getting a 6% yield, you're going to expect more of a 4% capital growth rate. And no matter what you do, you tend to not be able to escape this 10% overall return. So it's interesting to be able to consciously choose, where do I want my return to come from, more from the growth side or more from the income side. And that's why it can really help to have a clear plan and know which phase you're at in growing your wealth.
Yeah, definitely. It's a little bit like, developing an asset allocation, which is really, in simple terms, how do I spread my assets across property or shares or other asset classes? it's a little bit like, playing golf and deciding which club will you use for which shot.
Oh, yeah.
It's not that you can play golf with one club, or you probably can, but it's not going to really work out so well for you. And it's the same with investing. If you try and build wealth just with one asset class, look, if you do...
I'm a great putter, Stuart, and
Yeah.
sometimes I think, the way that my drives go to the next hole, I might be better just putting it down the hole.
Well, of course, there's exceptions that prove every rule, but...
But if I learned a few more skills or got some advice from someone that did know how to drive, then I might be far better involving that in my game.
Yeah, spot on. But,
Okay.
the benefit is that you can choose different asset classes, and they're going to do different things, much like golf clubs do different things. And so you're right. I mean, even if you look at even if you look at share markets, like the Australian share market is quite a high income market. It's just because we have what's called dividend imputation, which means you get tax credits for whatever tax the corporate has paid before they pay you a dividend. And also, for whatever reason, Australian companies have a greater culture of paying out dividends, whereas around the world, really, seems to be a much larger focus on reinvesting that income to grow the business. CSL is probably the only exception, or the major exception in the Australian market to that, and they've done a fantastic job. So, but if you have a look at the Australian market, returns about 10%, but the yield has always been about 4.5%. So you've got 4.5% income, 5.5% growth. But if you look to the US market, again, still 10%, but its yields around 2%. But, so there is a perfect balance in markets, and it's observable in capital cities longer term around Australia as well. And Perth's always been a slightly higher yielding market,
Yes, yeah.
but also a slightly lower growth market. But if you compare that to Sydney, it's a lower yielding market and a higher growth
Especially
market.
at the moment.
Yeah, well, it's a negative growth market at the moment, unfortunately. But you're right. The market is very efficient, and so if you're going to get a high yield, you can't, at least over long term, expect also a high level of capital growth.
And I guess with property, we have to look at what we're left with as well, because it's one thing to get a rental yield of a certain percent, but once we take out other costs, what are we typically left with?
Well, I mean, it depends on the asset, but
It
you
does.
could easily pay 1% in terms of yield out in costs. So, if you're renting a house in Melbourne or Sydney, you're kind of lucky to get 2%. You can talk to the yields much better than I in Perth. But if you're getting 2%, you're paying at least 1% in fees, and so you're walking away with 1% in terms of income return. Look, property is never, in my view, a good quality, high growth, investment grade property is never going to be a income asset. And this is to my point around choosing the right club for the right shot. The reason that you would invest in investment grade property is purely to build your net wealth, is purely an asset play rather than an income play. And that works perfectly well, particularly for people that do need to build their asset base. So I would argue that you typically build wealth in kind of two steps. The first step is build your asset base. And then the second step is then start tilting towards income. Whereas the mistake that some people make is they think, okay, I'm going out to work and every morning I got to get out of bed to go to work to generate an income. And what I want to do is replace that income so I don't have to get out of bed in the morning to do that. And so they naturally think, well, I need investments that are going to give me income. The problem with that is if I go and get investments that are giving me income, I'm going to have to pay more and more tax, particularly as I'm working. Whereas if you have a really strong net asset position, there's always going to be a way to eventually tilt that towards income or develop a retirement strategy. Like if someone walks in my office with no income but $5 million of net worth, well, there's always going to be a solution for them how they're going to fund retirement or the rest of their life. But if they've got $500,000 net worth, well, there's not much. They're going to run out of money one day. So if you are in the position where you're sort of just starting out, or you're younger, or you're further away from retirement, then for most people in that category, building wealth, building net asset value is the key. And so the best way to do that is find an asset that gives you as little income as possible in return for much higher capital growth. And property is certainly really the best asset that allows us to do that.
So what are some of the benefits of each of these asset types that lean into that primary focus of building your asset base?
So the major benefit of property, if we compare property and shares, and it is a bit of a silly comparison, really. I keep labouring the golf club analogy, but it's silly to sit there and compare shares and property because they're both great assets, but they have their pros and cons. And at a portfolio level, if you invest in both, hopefully
and if you get more educated. I used to think when I was starting out that, it is one or the other. You see everyone debating it so intensely, and they're so vested in that vehicle rather than what's the actual goal they're trying to get to.
Yeah, and normally it's a buyer's agent debating a stockbroker. Well, of course they're gonna debate. Their worldview is that one asset class is better than the other. So, the first big observation, which is really important, is gearing, is borrowing to invest. Now, most people wouldn't feel comfortable, and rightly so, going out and borrowing $1 million and dumping it in the stock market tomorrow. Just by the mere fact that stocks have twice the volatility of shares makes that a lot more risky prospect. And notwithstanding, most banks are going to say, forget about it. We're not interested in doing that unless you're going to contribute 30 or 40% of the funds. We're not willing to lend, and which is called margin lending, which used to be very popular up until before the GFC and now not so popular. But with property, it's different. It's got a lower volatility rate, which means our entry point is less of a concern. Even if you bought last year, okay, property prices have come off a little bit since then. But again, if you're going to hold for 20 years, it's not that big a deal. Whereas with the share market, you could invest today and it drops 30% over the next month. And, that's not a good starting point.
They also have a bit of isn't there such thing as a margin call with shares? So at least with property, the bank isn't going to typically, put the valuer back out to see what your property's worth. And they often really don't want to know as long as the interest is getting paid and everything's fine and hunky-dory and you're not going back to refinance or anything, then they don't need to look at it. But what happens on the share side? Because I'm not as familiar with that.
No, that's right. If your LVR, if you breach the LVR limits because the market has dropped, absolutely you'll get a margin call and you'll have 24 hours to pay down the loan back down to 70 or 60%, whatever it was going to be. So it's a big problem, and it's exactly what exacerbated the GFC. Margin calls did, and the
market, I guess, knows the price at every point because shares you can look up that price every day, whereas a property price is not always known or exact either.
No, but you're right that really, unless you default on the mortgage contract, the bank doesn't have a margin call facility. So even if they revalue your property and you're in a negative equity position, there's not much they can do about that situation as long as you haven't defaulted on the loan agreement. So as long they're in the business of lending money and charging interest, they're not in the business of selling property. So therefore, that's the biggest advantage, I think, is that you can invest in property without needing to contribute a large amount of your own cash, or maybe if you've got equity in other property, none of your own cash. Now, of course, you've got to then fund the holding costs. There's always going to be a shortfall between the net rental income and the interest cost of the loan. So that's your contribution towards the investment, but at least you don't have to make that upfront contribution. Whereas with shares, most people don't feel that comfortable gearing into shares. So normally it's going to be an ungeared investment, which means that you need to invest incrementally over time. And of course, mathematically, investing $1 million today in one lump sum is going to be better than investing $1 million over the next 10 years each month. 10 million in total over 120 months. And so mathematically, that's what makes property more attractive. It's not because property is a better asset class than shares. It's a more comfortable asset class with gearing, and gearing's a really important consideration because that can change the outcomes.
So before we jumped on the podcast, you mentioned just how critical gearing was, and I want to probe a little deeper as to how that affects the returns. Did you have any kind of example to show, what is the return it could end up like once you take into account, property's got a lot of other negatives and costs associated with it too, but it'd be good to see what someone is left with as a return.
Yeah, of course. Now, of course, when you think about property, and sometimes people are attracted to property because of the tax benefits, negative gearing and so forth, but which is great, which is a nice incentive. But if it's a capital growth asset, which is what I suggest it should be, it means you'll end up paying a lot of capital gains tax one day too, if and when you sell the property. So the government's not stupid. And when you look at the negative gearing tax revenue that they're foregoing, and you compare that to the CGT tax revenue that the ATO generates each year, they're wildly different amounts. So the ATO is just as much as a property investor for growth as you and I are. Obviously, there's entry and exit costs as well with property, stamp duties, buyer's agent fees, and then when you go and sell the property, you need an agent and so forth. There's maintenance along the way that you need to do. So, how do you balance all these things up? Well, I did a financial analysis of assuming that someone buys a property for $1 million, borrows the full cost, contributes the negative cash flow, the holding costs for that property for a period of time, but then sells the property in 25 years, pays the capital gains tax, repays the loan, etc. And what I used a calculation called internal rate of return, which really calculates what is the total return from the cash that I've contributed towards this investment, which is your annual holding costs. And it's about 14%, 13.96 or something, so 14%.
And what growth rate did you use for just on the property price?
So 7% growth, capital growth, 3% income yield.
Yep.
And 6% interest rate. Now, if you take the gearing out of that, so if you said, okay, the investor didn't borrow, but they actually contributed their own cash towards that investment, the return drops to 7.3%. And the difference is that you had to put all this money in up front. And so it's more of a costly investment because you've contributed a lot more. So
about double the return then.
Yeah, that's right. So it shows that property as an asset class is a good investment. It's not a bad investment. But because property with gearing, those two together, it's the gearing that does most of that heavy lifting. And that's an important distinction because sometimes people feel like, is it a property versus shares decision? But really, ultimately, it's a should I borrow to invest decision. And that's going to depend on, your financial position, your income, what other assets you currently have, etc. Lots of considerations. And if it's no, then maybe it's shares. If it's yes, I should borrow to invest, then property is the natural choice to invest in.
And the one thing your example doesn't take into account is if you went and dumped the $1 million cash into buying the property without a loan, that's going to mean that you may just have that one asset. So if you assumed you had the $1 million and you went and bought 5 properties at $200K or 4 properties at $250K, including expenses, you're controlling 4 times the asset base as the $1 million and you're getting double the return. So I don't know how to work that out quickly, but if you got 4 times the asset base and double the return, it's like, I don't know, that's compounding to the nth degree of it should be a simple calculation for someone that did high level maths at university engineering level.
I mean, of course it's obvious. And it was just you had $1 million.
Exactly.
You probably do a combination of both, some to put into an offset account to mitigate some of the gearing and then maybe some into shares and whatever. So it was a purely theoretical decision, but gearing has a big impact and often we, sit there espousing the benefits of property investing, but what we really should be doing is espousing the benefits of gearing.
Yeah, how good's this gearing?
And property is just a means to an end. I mean, Michael Yardney, who we both know, has often said property is just a game of finance property investing is a game of finance with a few properties just thrown in the middle. He's always identified that it's really just a game of finance more so than a game of investing in property, which, by the way, I shouldn't ever dilute the importance of buying the right asset. It's not just, but it's the the gearing element, if you get the right asset, that's going to magnify the returns.
So what's some of the other positives of each asset class, just to round things out? Because shares shouldn't be left without giving some, some positives too.
There's some fantastic positives with shares, and the biggest one is liquidity, and the fact that you can buy them in installments with smaller amounts, and you can sell them in installments as well, which in my, from a practical financial planning perspective is incredibly attractive. So, for example, if a client built up a share portfolio and they get to mid-50s and think, you know what, I only want to work 3 days a week or 2 days a week. Now, that income that they earn for 2 or 3 days a week still might not be enough to pay for living expenses. But if they've accumulated a share portfolio on the side, not only is it going to give them a predictable level of income, but also they could sell $20,000 of shares each year for the next 5 years until they're 60 and they can get their super.
Yeah.
You can't do that with property.
That I never got, like just how flexible that selling of the asset in small parts really allows so much greater versatility in that retirement phase or whenever you want to draw income. And drawing income doesn't have to be purely from the income of the shares. It can be through selling. And of course, when you sell a share, and does the same apply if you've held it more than a year? You paid the 50% capital gains tax.
And within a portfolio, you might have a portion of shares, a portion of listed property, portion of equities. You don't have to, and then you can choose which one to sell that's going to be most tax effective in a particular year. So it really does give you that flexibility. Whereas property, its greatest positive, which is the compounding capital growth, which generates a lot of wealth over time, particularly the longer the period you own it, is also a bit of a negative too when you get into retirement, because it is illiquid and it's not throwing off very much income. So you could end up being really asset rich and income poor, which is not really the position to be in. The only solution to that is go and sell a property. But then if you go and sell one big, large, lumpy asset, you end up paying a lot of tax. So it is I think that's a symptom of poor planning or no long-term planning. Hopefully, we can't take the money with us. We'll have to sell some of these assets or gift them at some point. And paying a lot of capital gains tax in a way is good because it means you've made a really large capital gain. But to try and avoid paying or at least delaying paying tax as long as possible, if you have a complementary asset class, it allows you to sort of do that. And then the other advantages of shares is really just the costs and potential hassle associated with it. So, with shares, it is very much kind of set and forget, particularly if you have an advisor looking after the portfolio. You're not going to have to deal with any tenant problems, property maintenance issues. There's no entry and exit costs, like in terms of, there's some maybe some broker commissions and whatever when you buy the ETF or whatever the share is, but they're negligible. Nothing like stamp duty and land tax and all these sorts of things. So there's some real added advantages as well. But I think the incremental investing and incremental divesting of shares is really the biggest advantage it plays in a portfolio.
Yeah, and I'd never considered just the tax implication, because you can't, go and carve off, and unless your property is subdividable, and sell little parts of your property and spread that out over different financial years to minimize its tax as you sell too. So that's why, when you're just looking at overall, top level returns, it doesn't take into account what you're left with in your pocket after you pay your taxes. So
and to navigate a sale, in the share market, that can be a little bit easier to do. You don't know what the share market will do over the next 2 or 3, 4, 5 months, whatever, but you might be able to sort of just incrementally, progressively sell down. Whereas with property, and particularly if you don't want to be a price taker, if you want to maximize your exit value, it is really dependent on what the market is doing. So even I know with some clients in situations, our goal might have been, let's try and sign the contract of sale this financial year. But in one way, it really is dictated by the market, because you put the property on the market maybe someone comes along on 1 July, a day too late, that's willing to buy the property. So that liquid market for shares can be a real added advantage.
So is there any ways to actually reduce the risks and increase the potential for consistent returns?
Well, there's lots of ways to reduce investing risk. And I would say risk is really just doing the wrong thing, of course, or making a mistake. And I don't think there's any mistakes that you can make that are a result of just random bad luck. In life, things can happen and sometimes you're just in the wrong place at the wrong time. But with investing, I think every potential mistake or actual mistake, if you've made them in the past, as a result of doing something fundamentally wrong. And that's kind of easy to say, but
it is easy to say, especially when pretty much everyone that's an investor has made mistakes at some point when they look back, and it's easier said than done, isn't it?
It is, but that's why I'm a big proponent of evidence-based investing, because that's the only question you need to ask yourself is, okay, but if I do this, where's the evidence it's going to work? Like I want to go.
Simple when you actually truly understand how to invest with evidence.
Yeah.
It cuts a lot of the noise out, a lot of the speculation. It's like we're not looking at hot spots or hot tips. We're going on what we can prove, and it's far better than throwing a dart at a board.
Yeah, exactly right. And you don't need to throw a dart at a board. That's the really answer. I mean, if you can achieve a 7 to 10% return over the long run, that's all most people need to build way more wealth than they'll ever need. So if that's all you need, that's what you should aim now. Hopefully you maximize returns and get the 14% that I talked about by gearing into property. But it's not about chasing those returns. It's just about doing something where the evidence shows that if you take these steps, that you will generate a return that you're hoping to achieve. So that's the way to reduce or minimize mistakes. The easy one is, get advice. That's kind of the overarching from someone that you trust, that someone is also independent. Because really, I've been in my business for 20 years. I haven't seen it all, but I've seen a lot. And I've seen a lot of different people in different situations doing different things. And I've learned from all those experience and observations. So if a client comes to me, they get that as 20 years of experience. I think knowledge is really valuable, but experience tells us how to apply that knowledge. And that's the critical element to avoid mistakes. So you don't need to go and find someone else, of course, but you're probably going to learn a little bit by trial and error. But really, I would keep asking myself, where's the evidence that this is going to work? And I think everything in investing and finance isn't or shouldn't be that complex that it can't be explained simply. And a lot of it is just basic logic or basic maths. Even the stuff that we've talked about today around gearing and property and shares and whatever, it's just basic maths, income and capital growth, and income's taxed differently to capital growth. It makes sense.
Exactly. Is there anything that we can do? You said just don't try to push things or chase shiny objects, or if you can just get the 7 to 10% return. Is there any sort of questions we can ask ourselves to steer us towards a better choice?
I think people that can be really focused on returns can end up making mistakes. The first thing I ask myself when contemplating an investment myself is, what is the risk? What's the downside? Think risk first and then think return second. Whereas I think a lot of people, particularly inexperienced investors, think return first and maybe not even consider risk. And I think Bitcoin's probably an awesome example of that.
Anytime I've actually lost money is where the return has been far in excess of what, is normal. And I didn't appreciate or downplayed the risk associated.
Yeah.
Thankfully, none of those have occurred any time in the last 10 years, but some big learning lessons in the early days.
So, if you take my example of the property and the internal rate of return, holding that property for 25 years being 14%, normally, theoretically, if you want a higher return, you have to accept higher risk. Return is merely a compensation for risk. And that means, for example, if you go and get a term deposit, you'll get 4 or 5%. There's no risk. But if you want to put all your money in venture capital or something, you might earn 30%, but it could be zero, and that's the risk that you're taking. And so what investors need to do is ask themselves, how do I get the highest return for the absolute lowest risk? An even better question might be, how do I get the highest return for no risk? And so if I use the property example, as I just referenced, the 14% internal rate of return, 14% is a really sizable return. Like normally a 14% return would be, this is quite a risky investment. But actually, if what I'm doing is investing in a blue chip area that's had 40 years of 50 years of strong capital growth over that period of time, and I'm buying an asset that's, fundamentally mostly land value, because obviously land appreciates, buildings don't, and that asset has runs on the board in terms of returns, and I'm going to hold that investment for 25 years, what is my risk? My risk is relatively low. Like I can see the asset. I know the things that drive property values tend to be static and factual, which means factual means I can verify them. I know this street and there's these amenities in the area, in the school and hospital, they're not going to change, or they've almost never change. And they're the things that are contributed to the capital growth rate. So in that situation, I would argue we've got quite a low risk investment here. And the only risk part of the investment might be servicing the borrowings over time. If there's a change in my personal circumstances, which I can self-assess, might be low risk, might be high risk, depends on my situation. So I've got a relatively low risk investment that's given me a 14% return on average compounding over a 25-year period. I think I've then turned the risk return equation on my head. So that's why I think thinking about risk first and then return will really help people focus on the fundamentals in the investment rather than getting dazzled by the return.
Good one. So I guess why should we consider having both in our portfolio? Because you've touched on a few times that there should be a mix. And we've spoken about some of the positives and negatives of each, and how does it bring this all together for us?
So I think as a general sort of life cycle of an investor, someone comes out of university or school or whatever and gets a job, they pretty much have no assets to their name and they've got to start building an asset base. And the other end of the spectrum is we get to 60 or whatever age we are, we decide to stop working and we need our assets to be able to fund our retirement, assuming we're not going to be relying on the age pension or the government to decide how much to pay us. Really, I've got to go from A to B, as I said previously, in 2 steps. The first step is really do whatever I can so that in 10, 20 years, I'll have a lot more assets to my name. It's all about build my net worth. Don't worry about income. And then once I've got a strong net worth, then I want to start tilting more towards income to complement the amount of capital growth and income, and hopefully get to a point by the time I'm retired, I'm getting a healthy level of income and also a healthy level of capital growth. And that way, mathematically, if I spend the income, I've still got the growth ticking away. And then mathematically, I can live forever. I can afford to live forever, ever. But the income
technology is going,
yeah, that's right.
Be living to 120, 150, and you don't really want to spend all of your asset base and have to live another 40 years on the pension, and pension may not exist by then.
Yeah, that's right. And you just never know what's around the corner. At least if you've got a strong asset base, you can help out children, grandchildren, whatever it might be. But you need that income to be substantial enough to actually really pay for your living expenses. So it's just, you need something other than property or in addition to property. So what I would typically say to people as a general rule of thumb is get the gearing in place first. We just talked about how powerful gearing is and how necessary it is to build your asset base. But everyone has a limit to their borrowing capacity, either imposed by their circumstances, their risk profile, or the banks. But we've all got a limit. And fair enough too. I mean, there's a point where over borrowing can be risky as well and actually puts you further away from retirement rather than closer to it. So you work out, what is that borrowing? Maybe it's a couple of properties, who knows? Get them done first. And then once you're on top of your debt and your cash flow position and so forth, that's when you start investing in other assets, such as shares that are more liquid. And then by the time you get into your 50s, hopefully you've got a really strong capital growth engine, which is your property, which is really building your net worth. And then you've complemented that with some shares and equities that are going to throw off a little bit more income and give you some liquidity to access some of those returns and investments in the future. And so by using a combination of assets at different times in your sort of investment life cycle, the aim is that by the time you get to retirement, you've got a nice balance of those assets. And that at a portfolio level, what you'd end up doing is balancing out the pros and cons. The property will add the capital growth and will underpin your asset base in case you do live too long. And the equities and super will provide most of the income and really fund, let's say, the first phase of your retirement, which could be the first 30 years, by which time the properties would have really kicked on in terms of value, and you'll have more money than you'll ever need.
Exactly. Like if property doubles every 10 plus years, by the time it's just astronomical when you extrapolate it out, isn't it? Like it's not that exciting what it may do in 10 years, but when you start looking at 30, 40, 50 years, oh, wow, it's like you can't even imagine it.
My wife and I were talking about a commercial property that's for sale, and the vendors want more than $3 million. And she was contemplating buying that commercial property about 25 years ago. It's in Richmond in Melbourne for about $600,000. And the problem is that we as human beings find those numbers really difficult. Like if she had have thought even with a high level of confidence 25 years ago, it'd be selling for more than $3 million. Well, of course, it's a no. You'd buy it every day of the week, and you'd be happy to pay $550 or $650.
Imagine what you'd do, the motivation you'd have to make that happen.
Yeah. Oh yeah, you do anything to make it happen. But the problem is, you look at that now. We were talking about it because we think you'd only pay up to 3 for the property, and they want more than 3, and that's what the conversation was about. But we have problems just getting our head around the numbers. What will that property be worth in another 20 years? Will it be 10, 15? I don't know. Like, I don't know. But it's always along the road. People have had problems. Clients have had problems with understanding that properties will be worth $2, $3, $4, $5 million in 20 years from now. It is inconceivable. It's hard to conceive today. And that's always the challenge. Now, not all property, of course. It's got to be well located. It's got to have the fundamentals to drive that level of growth over time, of course. But the right assets will. And I think, I said to her, imagine if we had a time machine and we could go back and buy these properties. But, we kind of had the opportunity today, and let's just hope in 20 years' time we won't be regretting not taking action today.
Well, that's it. And the further you get into this, you realise that if you're taking action and letting time compound, then you're going to be far, far better off than those that don't. So,
well, time is a really big ingredient. I mean, Warren Buffett has a saying that you can't make a baby in 1 month by getting 9 women pregnant. Some things just take time, and it's true. Like if you buy a really good quality asset and hold it for many decades, you'll make a lot of money. There's just no doubt. I mean, it is actually that simple. It's simple, but not easy. To hold it through the times, to not. I answered an email from a client today about he bought an apartment. The apartment hasn't done well. It's a great apartment, but just hasn't performed yet. And so part of my job is to make sure my clients don't make mistakes. So definitely don't sell that asset. It will perform. You just need to have the patience. So it is difficult at times, particularly when it's your own money and you're sort of emotionally invested and so forth. Excuse the pun, but really it is. It's a lot about discipline, and quite often with investing, the right thing is to do nothing. If you've got the right investments, of course, you've got to do something if you don't. But yeah.
No, thanks so much for spending the time today to run through the different asset classes and the pros and cons. And hopefully that's going to really give people a clearer way forward, because it's just hard to get anyone to look at these things unbiasedly. And if people do want to chat to you about your financial planning and your holistic approach, we'll put the details for ProSolution private clients in the show notes, and definitely worth getting in touch. If you've got your podcast and book as well as great starting points, don't you?
Yeah, definitely. Just Google Investopoly which is my weekly podcast, and it'll give people, I think, a flavour for what we think about and what we talk about. So it's always a good introduction. But it's been wonderful, Jared. I enjoy talking about these things. So it's more of a pastime for me than a job. So I appreciate it.
Thanks, Stuart.
Take care.
Just a reminder that the information discussed in this podcast is general in nature. As we don't know your specific situation, you should always seek professional advice before taking any action. For free market reports on your suburbs of interest and other helpful resources to grow your wealth, make sure you join my property investor update at investorsedge.com.au/join. And finally, make sure you're a member of our Perth Property Investment Facebook group to be part of the conversation with other like-minded investors, get help to your questions, and get a feel for what's going on out there in the market. I'll see you in the group.